Welcome to Splice Beta, everyone. I'm going to quickly introduce us because I know none of you know who we are. You've never heard this before. I'm Rishad, and Alan. We co-founded Splice about 5 years ago, and thankfully for us, Shirley Chong, our producer, joined us just last year. And without her, we wouldn't be doing this. Alan, tell us why we do Splice.
Our mission at Splice is to help drive the radical change of the industry by supporting bold and forward-looking media startups across Asia.
We're Splice Beta is where it all comes together. This is where we bring the community together. We did this last year for the first time in Chiang Mai in Thailand, and we had 300 people from across the media ecosystem come together from around the world. People from the funding and startup, the funding ecosystem, people from media organizations worldwide, the tech people, the big tech people, the data people, design people, and also a lot of students and people who actually teach journalism and media. We like the ecosystem approach.
We now have over 40 sessions lined up at Beta. We are in session number 9 right now, I believe. We have 46 speakers or so. 50% of them are female. We're very excited by that. Overall, we've got 5 stacks, which is all split up by different days so that you all learn different things. If you want to get an idea of what these stacks are, just go to our website. Every Mondays, it's business, and that's what we're learning today. Tuesdays are products, Wednesdays, audiences, Thursdays, operations, and Fridays are media careers.
And if you want a little more detail about the program, just go to splicebeta.com/program. You can see all the speakers and all the sessions there. Put them in your calendar. Big shout out to our sponsors. We're so grateful for your support. Facebook Journalism Project and Konrad Adenauer Stiftung, thank you so much for being in our corner. Google, Luminate, MDIF, which is where our speaker of the day in this session is from, Kevin Brockland. Thank you so much. Pat Bird, Puri Lahiri. We also like to thank our friends at AFP, FOYO, Media Institute, and IMF. We are also very grateful to Click to View for helping us with the video part of this session, as well as Puma Podcast for all the audio help that they've given us.
Ground rules, very straightforward. If you are tweeting, please tweet with the Splice Beta hashtag. We've also got a Telegram group. If you haven't already seen it, this is a great place to get updates really quickly, and also, again, to find ways to connect better with each other. If you're speaking, use headphones and microphones. If you are interested, if you have questions, leave them in the chat box on the right-hand side. In Google Meet. Leave also your comments in there and links and also email addresses. If you're not speaking, make sure you're on mute. Otherwise, Shirley will do that for you. This recording, by the way, is also publicly available on our YouTube channel and our Facebook page. If you see any kind of weird shenanigans happening, like porn bombing, well, it's a thing that happens. We'll kick the user out and we'll get on with it. Most importantly, be kind and be generous. All of us are trying to figure out what the future of media is like.
I just want to quickly cue just for tomorrow. We've got Nikki Torres, our dear friend, and the founder and host of Chief Best Friends, her podcast that she launched at Splice Beta last year. She's going to tell us about what she learned running her own podcast and how you could do it too. That's tomorrow, September 8th at 4 o'clock Singapore time. And the next session will be our dear friend Robin Kwong from the Wall Street Journal. He has this amazing job title. He's Newsroom Innovation Chief, and he pushes that title to its limits. He's awesome. He's going to tell us how they prototype news products at the Wall Street Journal. That's coming up at 8 p.m. Tomorrow, Singapore time. But for now,
Kevin Brockland. Everyone's kind of been talking about this. Everyone is excited to hear what Kevin has to say about the investment space. Kevin's really interesting because of his experience in funds and the way he thinks and approaches investments. A lot of media startups in this region have turned to Kevin at one point or another to ask for help and knowledge and advice. Today, he'll be talking about how to plan your process toward fundraising, how to ask those questions early, how to get your milestones in place, so that when it comes time to finally ask for funding, you have something to show for. Kevin, all yours and your wonderful office there.
Cool, thank you. Let me share my screen. And you guys should now be looking at the presentation.
We are, thank you.
Cool, cool. Thank you. Very happy to take part in Splice Beta. I was really looking forward to a real life event in Chiang Mai, but obviously circumstances changed. But so far, the sessions that have gone on have been fantastic. So very happy to be part of it. So talking here about preparing for funding, how to plan for an ask before you actually need it. So this topic is actually rather broad. So what I've tried to focus on is the areas that I believe that entrepreneurs need to put a little bit more attention, based on my experience with working with many different companies over the past. There are several areas which I have omitted for the sake of time, not commenting on their importance in the preparation for going for a fundraise, but simply to focus on the areas that I believe that entrepreneurs and business owners need to put a little bit more attention. So I will be leaving some time at the end for Q&A. So if there isn't anything that I touched on that you have a burning question, always happy to address. So in regards to preparing for a fundraising, the overarching advice is most certainly going to end up being to start early. It may be more difficult than you expected. It may take longer than you actually think. So you need to hang in there, hence the cheesy cat photo that I just couldn't help myself but toss in here. So it's time consuming. It's a time consuming process. It's going to require the attention of the founders. It's going to require attention of senior management as you follow through the process. So it's important to start early, and it's very important to be prepared and be organized so you can approach this process in the most efficient and time-effective way. So through this presentation, I thought I would break it down into what I see as kind of the initial thought process. And in so doing, I've divided it out into basically 3 points that build upon each other. And the first one of these is to know what you want. When you need money, how much you need, and for what purpose. Building from that, you need to know who you want it from and why, because not all money is created equal. So you're going to want to be able to approach that strategically. And lastly, in order to be prepared and be organized, you're going to need to know what they're going to be looking for. The best way of being prepared for those conversations, because as I said, it can be time consuming, is to have a very solid understanding of what to expect once you start approaching this. So getting started with the what you want, it really all starts with a plan. You need to be able to put together a solid plan so that you can actually know when you're going to need the funding. As I said, how much funding you're going to need and for what you will spend it on. These are going to be critical questions that any source of funding is going to ask you, and you need to be prepared to not only be able to answer these, but to be able to have a substantial amount of information in order to support these components. So the overall process of financial planning, I'm going to leave outside of scope, but I do want to address it a little bit in regards to the aspects of the planning process. So you want to plan ahead, you want to plan again and again and again. I've always viewed planning as an iterative process. I've never met a company that hits their plan 100% on and does that consistently. A plan is an iterative process to where you're needing to be able to review and revise it over time. And the overarching characteristic that you're needing to be able to address is, what is the opportunity that you're taking advantage of? The opportunity can vary widely among circumstances. It can be time-based, it can be circumstances-based, but you need to be able to identify what that opportunity is and be able to develop a strategy of how you will actually take advantage of this opportunity. And as you come up with that strategy, then that leads you into the actual implementation steps. What are the tactics that you'll take in order to effectuate this strategy? What are the resources that you're going to require in order to do all of this? And that's really the building blocks in order to understand the components of what is the opportunity, what's the revenue opportunity, what's the growth rate, what's the strategy that I'm gonna end up deploying in order to take advantage of this. In this implementation, what are the steps that I'm gonna actually end up having to take? What are the resources that are gonna be required in order for me to actually deliver on this strategy and be able to take advantage of this opportunity? As I said, you want to be able to leverage the insights from going through the planning process in order to be able to say, when are you going to end up needing the money? And it's going to be very important so that you can plan ahead enough in advance so that you're not running out of money before you end the fundraising process, because the last thing that you want to be is out of money and looking for money. You'd rather be sitting on a little bit of cash in order to be a little bit more comfortable there. You're going to want to know how long that money is going to actually last you. What's going on with that money? What are you using it for? So planning can be very complicated. If you're not an accounting person, if you're not a finance person, it can honestly be quite complicated, and that's okay. It's not necessarily inside of every founder's skill sets, but I think that the thought process of opportunity strategy implementation is something that for most entrepreneurs is fairly inherent, because that's what made you drive to be an entrepreneur in the first place. The planning just comes around being able to put a little bit more specification and measurements around it. So I want to give a little bit of simple advice. As I said, the full details on planning, I think, is a little bit out of scope. So I don't want to get too technical there, but just touching on a few do's and don'ts here. When you're going through the planning process, you do very much want to know your market and your value proposition to them. It's going to be very difficult to develop a proper plan if you don't know who your market is, the characteristics of them, and what your value proposition is to them. This is going to be driving indicators and information that's going to allow you to understand what's your revenue opportunity, what's your potential growth rate, and how are you going to be able to deliver that to them? What are the resources that you're going to end up needing in order to deliver that value proposition to your market? An important thing, don't forget that your market may actually have more than one side to it. I know Ross mentioned this in his session earlier, but oftentimes a media startup, especially one that's more so from a journalism background, will see it more on the audience perspective, but start forgetting that you're actually serving multiple markets. So, if you're looking at an advertising-based business, sure, the consumption of content is your audience, but the advertiser is not necessarily buying your content. They're buying your audience and the characteristics of them. So it's going to be very important that as you go through the planning process to understand the different angles and the different aspects of your market, the different markets that you're servicing, and what your value proposition is to them, so that you can better understand the strategy and tactics that you need and the costs that are going to be associated with it, as well as the growth opportunity that you can achieve. Do you know your go-to-market strategy? How are you actually going to get it out there? How are you going to grow an audience? How are you going to deliver it to them? All of these different components that are going to go along with being able to put your product out there, whatever that product may end up being. And don't ignore that there is competition. We live in a world that's abundant of choice. There's not very many companies that have zero competition. So you do actually have to have a strong understanding of that competition, whether it's competition for ad dollars, competition for attention. you do need to make sure that you're putting proper attention into the differentiation with competition and how you're going to overcome those gaps. This one I can't stress enough. Do know your milestones and your critical KPIs so that you can know whether or not you're on track. As I said, I've never actually seen a company 100% hit their plan. But the important thing about planning is that you're developing out milestones and critical KPIs as early indicators so that you know whether or not you're on track. So instead of wasting time on something that's not working, you can be able to see that in advance, recognize that data, use that in order to adjust your strategy, plan again, and start moving forward. Now, don't get lost in the aggregate, as the details are what make it. I very frequently have received financial plans or pitch decks where everything ends up talking about the top line growth, which is perfectly okay if you're sending me summarized information. But if you don't know the underlying sources of revenue, if you don't know the different revenue lines and their respective growth rates, if you don't understand your different customer segments and what their growth rates are, you're going to really start losing a little bit further down the road once you start getting into more intensive conversations around the validity of your assumptions and your strategy when you start getting into these funding conversations. So it's better to get those in advance and start planning around those finer details. And do prepare a cash flow statement, ideally monthly. If you're looking for funding, it's obviously important, as I've said, to know when you need money, how much, and where you're going to spend it. And the backbone of all of this, to be able to demonstrate it, is your cash flow statement. You want to be able to know the ebbs and flows. Most every business is going to have lumps and movements. There's some businesses that are a little bit more steady, but a large amount of businesses, especially in the early days, are going to be a lot more lumpy. So it's going to be very important that you understand your cash flow statement. And don't make unrealistic forecasts that are impossible to achieve. There's one aspect of simply being aggressive and trying to take advantage of an opportunity head on. But if you're making assumptions and forecasts that are not grounded in some basis of realism, it's going to be very difficult to convince any sort of funder to take a risk on this. So you need to be able to have a hypothesis for why something is going to be achievable and have sufficient enough data in your corner on your product, on your audience, on your different components of your business in order to support those hypotheses, so that if you're coming out with a forecast, it's achievable. It's difficult to achieve, but it is achievable. Because wildly unrealistic forecasts are going to be a very good way to end a conversation before it starts. Do know your cash needs and how long it will last you. If you're going to get down the road to a point to where you're asking for funding, you need to know what your actual need is, and you're going to need to know how long it will last you. And don't plan for too short of a term and think that you'll never have to raise again. There's some companies that can raise once and then bootstrap from there on out. But most companies are going to end up raising and then need to raise further down the road again. So when you're planning out your cash needs, you want to make sure that you're planning sufficient enough of a runway into the future, so that it's giving you time in order to implement this strategy in the near term and provide you enough time afterwards to run another fundraising process. So there's various rules of thumb there. But certainly I would say try and put at least 2 to 3 years worth of a runway off of what you're trying to ask. You can always work back if you're having more difficulty raising money and try and temper the plan. So that's on the planning side. So if you've gone through all of this, you should at this point know how much you need, when you need it, and what you're going to use it for. So the next important thing that I was referencing is who you actually want it from. And the important thing to remember here is this is not just about the money. This is your business. This is your passion. And especially if you're looking for an equity partner that's going to be in there for the long term, you're looking for a partner. So you want to have some level of certainty of who you're getting involved with and what type of partner they're actually going to be. There's one aspect of the money, there's one aspect of the working relationship, and there's also going to be an aspect of what other sorts of value add a particular investor can come back with. So I'd really encourage, in order to go through a little bit of investigation in regards to who your potential funding sources are, and try and run an investor pipeline so that you can actually screen and sort. And that leads me into kind of breaking it down into a little bit of like a sales funnel process to an extent, where you're basically taking the universe of potential funders, you're trying to screen through them. Once you've screened through them and narrowed down that list, then you're going to try and end up getting those connections to where you can get those points of contact. And once you've got that, you lead into the pitch. And I would highly encourage that when you're at this point and you're planning ahead on who you're going to try and approach, that you actually put it into a spreadsheet or something and create a proper investor pipeline. If you're trying to wonder what this could potentially look like, there's a lot of freely available resources that are already out there. There's a really good one that was put together from a woman at Techstars. So if you actually Google investor pipeline, you'll probably come up with a Google sheet that she's made freely available. But whether it's that or something else, it's good to be organized so you can keep this information in a way that's going to make better use of it. So let's talk about these individual components a little bit more in detail. So the screening aspect is really about trying to know your options of who are the potential funders out there. Now the starting point is there's different funding types. I'm not going to go into too long of an explanation here on the different funding types because I'm going to try and keep it a little bit less technical. But essentially, you could be talking about getting a loan. And there's certain types of funding, that's a certain type of funding type that has its own particular considerations that you'll need to address if that's the route that you want to take. There's equity investors, which is another particular type. There's hybrids out there that take some form or another between the two. And then you have grant funding and other sorts of other similar sorts of funding like that. And not just the funding types, but then you have different investor types as well. So MDIF, for example, we would probably fall into like an impact investor, to where, sure, we're looking for a financial return, but we're also a mission-oriented firm. So we have that double bottom line objective to where we're trying to reach social impact metrics along with financial return metrics. And so there's also the more commercially oriented VC funds that you may look for. They're going to have their own profile and characteristics that they're looking for. They may have their own types of relationships. There's investor types out there that take more of have different operating models in the way that they approach their investing. Some of them lean heavily on operating partners that can actually work with companies a lot more. Some of them play the numbers game to where they'll invest in 100 companies with the expectation that a small percent will succeed and the rest will fail, but those small percent will basically repay the fund. So it's important to understand those investor types, so that when you're going through and trying to screen through these different options, you know what you're getting into. And that leads you into understanding how do you actually match their criteria, because you don't want to spin your wheels taking up a lot of your time trying to have meetings with different funds when you may not match their criteria, or the funding types and the investment type, the investor type that they are, don't necessarily match. So it's very important for you to go through and actually screen these out, because the funds themselves, they'll be screening you on a lot of these criteria. So many investors will have industry focuses. MDIF, obviously the M in our name is media. We focus on media. Different investors will also have their own specializations. That'll be important to see whether or not they can actually bring any sort of domain expertise to the investment. And that's things that we can touch on further down here. There's also investors that will focus at different stages of a company's growth. There's funders out there that are willing to take risky bets on companies that are pre-revenue. There's some companies that will not. There's some companies that only want, there's some investors that only want to invest in growth and late stage companies, whereas that's outside of the realm of other investors. So it's important to understand when you're looking at this universe of investors, what stage is your company at and how does it actually fit with these investor types? And that plays a big role into the size of check. So whether or not you're raising for your first time or you're raising for a subsequent time, it's important to understand what the average check size, what the average investment amount that an investor will put out there is, so that you can know whether or not it's actually a fit. You know, if you're a company that's going out and trying to raise $500,000, but you're approaching an investor that has a minimum check size of 10 million, it's just not going to work. You might not even get a response, and if you do, you might just end up wasting a lot of your time. Or who knows, maybe they fall in love and make an exception. But it's important to have that understanding before you spend too much time knocking on a door that's not going to open. As well, different investors are going to have different geographical focuses. MDIF, for example, there's some countries that we work in and there's some countries that we do not work in. It's important for you to do your research so that you understand whether or not you actually fit the criteria of the investor that you're approaching. So this is really a lot of the criteria so that you can make sure that you're not going down dead ends, because the process of dealing with the investors as you go through all of this can be rather time consuming, as I said. So you really want to make sure that you're going about it in the most efficient way possible and focusing your energy on the more high probability outcomes as opposed to the low probability outcomes. And another aspect of when you're looking at these different funding sources is to understand some of their funding past. What have they funded in the past? Do they understand your business? If they don't have an industry focus in what you do and are perhaps more of a generalist or more broad in their funding space of what they're willing to fund, will they actually understand your business? Media is a complicated business. There's not really a one size fits all. And especially if you're doing something novel within the space, are they actually going to understand your business? And if the answer is it's maybe not, and you're going to have to spend a lot of time explaining, it doesn't necessarily mean don't pursue that. It's just going to give you a heads up that it's going to be an extra barrier in order for you to overcome, so that you can approach that with that investor with that understanding that you're going to have to do some storytelling and some framing in order for them to better understand what your business is and put it in a context that they'll be able to understand. Also related to the past fundings that they've done, do they have anything in their portfolio that could potentially be competitive to you? Because that could be a hard no. Or it could mean that they have to go through a process of managing their own internal conflicts of interest so that they could actually pursue you. MDIF, for example, we've invested in multiple companies that operate in the same country. But we do have to go through processes when it's perceived that they could be competitive, and we have to manage those risks. And we take that very seriously because we view our partners as in the high regard that we should. So this, as I said, this leading down into figuring out whether or not you are going to actually match their criteria. But what about them matching your criteria? It's really not all just one-sided. And there's many different things that you could toss in here. You could toss in where that investor's source of funding is coming from. If you're talking about a VC fund, who's the investors in that fund? So you know whether or not you're getting involved with a person or an entity that, even though there may be a layer or two of separation, that you know what you're getting into. The part that I'd like to focus on here, though, is more of what value do they bring to you. And so there's many different types of value that an investor could bring. I'd like to think of MDIF as smart money that brings a lot of value to our portfolio companies through the various touch points within the organization and the fantastic team members that we have across the globe. But when you're analyzing, and I should put this more broadly, when you're analyzing any investors, you should try and understand what value do they bring beyond just the monetary component. Are they going to have any sort of ability to do any mentoring for you? Is it somebody that could be a very strong participant on your board of directors to where they can provide a lot of value in helping you set strategy? Are they bringing experience so that they can help you through processes of building a business since they may have gone through it before? Or perhaps their experience that they're bringing to the table is in a functional area to where you recognize that you have a weak spot. So it's good to fill in those gaps by bringing in an investor that can provide some of that experience and mentor you towards that end. Are they providing you with any sort of network benefits? Network benefits could be introducing you to the other entrepreneurs that could potentially be going through the same difficulties, trials, and tribulations that basically every entrepreneur goes through. Are they providing you with a network that could lead to revenue opportunities or subsequent funding opportunities? There's different ways that could end up being. Or could they potentially provide you with possibilities for recruiting? Do they have a good network amongst techies where they can help you attract top talent? There's many different aspects of value. So let me try and put this into a little bit of a visualization just to kind of clear this out of how I'm viewing this. Is essentially you're trying to understand the funnel on the other side so that you can screen through those funders who you match. And then you're trying to lead that over into the other side to where you can reconcile that and take that list and then prioritize it based upon those who you match, who also match what you're looking for and what you prioritize. So there's not really a hard formula that I would necessarily say in regards to setting this prioritization, but I would recommend trying to create some sort of rank order. Ideally, I would love to see every company be able to find an investor that has the characteristics that fall right in the middle of the overlap of the Venn diagram. But it's not necessarily always going to be the case. Maybe you value mentoring and experience above all else, and that's really what you need. So when you're looking at the universe of potential funders and trying to figure out who matches what you want and what you actually want, it'll be important for you to try and set some sort of prioritization. And I say this primarily so that you can focus your attention and try and, again, focus on the high probability outcomes, the ones that are going to give you more of what you want. You'll likely get more no's than yeses, but at least if you can focus your energies, it'll save you time and be less of a distraction from the day-to-day operations that I'm sure anybody out there that's done a fundraise realizes the amount that it can pull you in different directions. So once you've gone through and done the screening and you have your investor pipeline, you want to move into the next stage, which is trying to connect. And here, the relationship really matters. So it's very important to try and find a way that you can actually connect on a personal basis with somebody at the potential investor that you're trying to seek after. I wouldn't necessarily say just go straight, do a cold connect. You can, but I think that there's smarter, more effective ways to do it. And this revolves around first starting off by trying to figure out who do you already know? What's your existing network look like? Do you actually know any investors already? What about entrepreneurs? Entrepreneurs that may have been funded by another investor. What about friends and family? Anybody in the business community? by understanding your network, you can begin to understand how you can make some of those connections. And when you've gotten your narrowed down list that you've screened through and prioritized the investors that you're looking for, you wanted to see who do you need to know at those organizations. Who are the decision makers? Now, the decision maker may not necessarily be just somebody that's on their investment committee, because you're also going to need somebody that's going to champion it through the process at the investment firm. And it may be somebody that's not necessarily even involved in the decision-making process, looking for ambassadors. Ambassador not being a political position or anything like that, but somebody that can be a strong promoter, that has the respect and their opinion is seen in regard at that investment firm. And so if you can find somebody that can both be a champion for you, as well as influence somebody and build a relationship with a decision maker, you're going to be well on your way in order to be able to be positioned to move further down the process and in having an effective fundraise. So if you know who you need to know, if you know who you already know, now you can start trying to figure out how can you connect to them. You start off, you try and match up your networks with who you need to know. You figure out what are the degrees of separation, try and figure out who knows who can make the introduction, really make use of your network, getting those introductions, whether or not it's somebody being able to invite you out to an event or get a coffee or get a lunch. A lot of things that in the post-COVID world aren't necessarily as feasible as they once were in the past. I think maybe perhaps the forwardable email in our days of virtual chats and so forth is probably going to build up in importance. And so the forwardable email is essentially another way of connecting. And so if you were to ask a business colleague to give you an introduction to an investor that they know, if you just say, hey, can you introduce me? Chances are they're going to reach out directly to that person and say, hey, do you mind if I put you two in contact? But in order for that to get anywhere, they're going to need to actually provide some explanation of, hey, can you meet so-and-so from company XYZ? They're doing some interesting things, and provide some background. So if you can actually have a prepackaged email ready to go, you're going to make it easier on your network to send you those introductions. I can tell you from experience that there's frequently a lot of requests for this. We always love, everyone within the space always loves trying to be as useful as possible. But I reference this so that we can try and make it as frictionless as possible, so that you can make the most use of your network and really get out there in order to get the connection. I can't stress enough that a lot of this is built around same thing with doing sales. You really want to build a personal relationship with somebody and get in front of the person and have a conversation before you get into an ask. If you're going to reach out to an investor, I would say this from my own personal opinion. Perhaps there's people that would disagree with me, but I would say reach out, connect. Don't start off with the ask, but start off by trying to have a conversation. It can be asking me my thoughts on what's going on in the industry, in your particular market, seeking advice. Whatever the case may end up being, my personal preference is to not start with the ask and build towards that. And I think it actually ends up playing out pretty well if you pursue that strategy. So now let's say that you've gone through, you've screened, you've connected, and now you're ready to move on to the next phase, which is the pitch. Now it's very important here to be ready before you go. And what do I mean be ready before you go? You have to have your story ready. And so storytelling is a big part, because you need to be able to tell the investor that you're approaching, why you? Why now? Why is what you're doing so interesting that I should join up with you and invest in you? And why is now the time? you need to be able to do a little bit of storytelling. You need to be able to create that narrative so that it connects the dots. And this is a building block for not just the elevator pitch, not just that feeler when somebody is asking you for a 60-second introduction, not just that forwardable email. All of these different components need to be built around the storytelling. And I would certainly recommend that you take a little bit more of a customized approach to this. It doesn't mean that your business necessarily needs to change, but because it's storytelling, you need to have an understanding of who your audience is, who the investor that you're speaking to is, so that you can relay that story in a way that's best suited for that recipient. And if you as you're getting ready in order to have these conversations, I think practice makes perfect. If you have a colleague or if you have someone close to you that you can practice with, it is very, very advisable in order to go through a little bit of practice sessions, because once you get involved and you get in front of the investors, and some are more friendly than others, but no matter how friendly of an investor that you get, you will get grilled. Any of those assumptions that you've made in your beautiful projections and plans, they're going to get questioned. They're going to try and question the validity of the assumptions. They're going to try and get a better understanding of why do you think this is going to happen? Why do you think this is going to happen? Why do you think you can do this? And so you need to have good background around on all of your hypothesis and all of your assumptions, and have it fact-based. Be ready and be capable of sticking to the facts. One of the worst things that could possibly happen is when you're getting into a good conversation about the business, and you can see a little bit of and see that growing excitement in the person that you're discussing it with, and you can feel that they're understanding you, but then they ask you a tough question and you have to say, I'll have to get back to you on that. Now, sometimes it could possibly be appropriate. Perhaps it's something that's so out of the box that it's not something that you could have possibly prepared for. But 9 times out of 10, it is going to be something that you could have prepared for. So it's going to be important for you to try and be as well prepared as possible, because an I'll need to get back to you on that is frequently viewed as an I don't know, and an I don't know is viewed as a failure in the process. And so just to hit on it one more time is stick to the facts and be well prepared. Practice makes perfect. View it as kind of a test prep. Now, again, before you go out and you start pitching, you need to ask yourself, are you prepared to ask for funding? Are you able to get in front of the right person so that you can spend your time most effectively? And do you know your story? Do you know the facts? And do you know all of this before you go? And if you do, then you need to be able to round it out with this last component that I was talking about, which is what do they look for? You know, what is the investor going to be looking for? If I can make that connection and I can get in front of them, what is the kind of stuff that your average investor is going to be looking for? And this is honestly where it gets a little bit intense. Some investors more so than others, but it's more important than ever once you've started getting down this road to be prepared and be organized. So before I jump into the specifics of it, I think it's important to just kind of recap a little bit on what a typical VC process looks like. I've taken this from another VC fund that has a great blog out there. But essentially, you're going to end up having that initial meeting. That initial meeting leads into another round where they start getting into some more basic analysis and start screening through you. And if you can pass through that, then it gets even more detailed. And if you pass through that, you may end up starting to get into the decision loops. And so you need to understand that the funders, the investors, they're managing a funnel too. So they're meeting a large number of potential investees, but only a select few of them get into that analysis stage. And then a smaller group gets into the due diligence stage, and a smaller group and a smaller group, and so on. So it's important for you to understand where you're going to be fitting in to the different stages of their funnel. Because fundraising, honestly, is a bit like sales. You're selling your value. So knowing that they have a funnel, you need to be able to understand that and manage your own funnel. You've already built the pipeline. Now you need to be able to understand where you're at in closing these deals. It's a process, and the process needs to be managed. So now let's jump into the types of considerations, the types of characteristics that an average investor is going to look at. So again, there's many different investor types out there, and not all of them are going to look at a company the exact same way. And so I'm going to approach it more upon the way that I really look at companies. And I look at companies as a starting point off of three primary characteristics. It's the people, it's the process, and the product. And if the company can get me sold and bought into that, then I'll start looking at what the potential of this is. And that's what will get me motivated in order to try and move it up the chain in order to get this project funded. So let's talk a little bit more about the people. You know, if anybody didn't catch Kirill's presentation, I would highly recommend going on the Splice YouTube channel and checking it out, because you would spend basically his entire session and it would fill up what I'm talking about with this people aspect. There's so many questions that he listed in there that are questions that an entrepreneur should ask themselves. Things that run the full gamut of characteristics. And one of the things that he highlighted that I really loved was passion, not emotion. You need to have a founder. Being an entrepreneur is one of the most difficult jobs out there. It's much more difficult than being an investor, I do have to say, even though I sit on the investor side of it. Being an entrepreneur is incredibly difficult. So if it's not guided by passion, then it's going to be very difficult. But an investor is going to do an analysis on the strength of the management team, and honestly not necessarily stopping at the management team, because a company is only going to be as good as the strength of its people. And it's understandable that depending upon the stage of a company, you may not have the full breadth of skills that a more developed company will be at. But it's going to be important to show that within the key components, that you have the domain expertise, that you have that passion, that you have the ability to be introspective enough to recognize your gaps, and not only recognize those gaps in the competency and the skills of the team, but be able to develop a realistic plan on how you're going to plug those gaps and fill that in, and create a hiring plan that makes sense, that's tied in to the strategy and the implementation and so forth. If you can build that out and get the buy-in on the strength of the team, that is a huge starting point. There's a large number of companies out there, and I think any investor, anyone that's active watching the startup world or business community in general could honestly say there's a lot of companies out there that, you know, they have a mediocre product, but because they have phenomenal founders, somehow they built a great business out of it. Now, on the other side of that, I've seen companies that have really amazing products, but not a very well organized or effective management team, and that great product just didn't go anywhere because they couldn't keep up. So it's very important to have an understanding of your strengths and weaknesses as a management team. And it's not necessarily a negative if you're missing some skill sets, but it's important that you have a plan on how you're going to fill those out and be conscious enough to recognize the skills that you have and the skills that you need to acquire. After going through the analysis of the people, it's to step into the process. Again, depending upon the stage of the company, your processes may be less sophisticated than a more developed company. But what is important is that you're putting the foundation to build that business, the processes, so that you can know your customer, that you have some form of a process to where you have a feedback loop and are collecting information so that you can know your customer better and better. If you're serving an audience, how well do you know your audience? As you're continuing forward, do you have the processes in place to capture that data? Whether it's Google Analytics, surveys, whatever the processes may be, depending upon your particular business, product, etc. Do you have processes in place in order to have a better knowledge base of what your customer is, and relatedly, to know your value proposition, how well it's being adopted, what the reaction from your customers are, and how that's being perceived. Are they perceiving the same value that you've assigned to it, that you hypothesized that they would assign to it? So you need to be able to have these core processes in place so that you can review and revise and leverage these insights for continual process improvement. If I see a company that has these processes in place to where they're constantly collecting information, they're constantly tracking what they're doing, they're constantly looking at it, they're revising, they're reviewing, they're revising again, and so on and so forth, and constantly trying to be better, I'm going to look at that company and say, hey, this is a company that has the ability to grow. And so it's those internal processes that are going to be very important to demonstrate. And it goes a little bit beyond just having a written operating procedure manual. It's something that's very hard, honestly, for investors to assess, especially nowadays where I can't physically visit a company. Previously, you'd go visit a company, you'd spend a day or two, you'd talk to different levels of the team, you'd ask a lot of questions, you'd get a feel for how the information flow goes from one department to another, within departments, all of that. But it's very important in order to have that understanding of that continual process improvement within the organization. So jumping past the process gets us into the product. And by product, I'm not necessarily focusing just on what the quality of the product is. I'm not necessarily focusing I am focusing on this information, but I'm not highlighting it here in my description. I am going to look at what the quality of the product is. I'm going to try and get an understanding of the technical aspects, do my research on that, have an understanding of what your value proposition is. But all of this is leading into being able to look at what the traction that you're actually getting is. And again, with companies that have multiple markets and multiple value proposition, it's going to take a view at each one of those different segments. But in general, for any particular one, I want to be able to see that you're actually having forward momentum. So the traction needs to be definable. Depending upon the company, the traction is going to end up meaning different things. If you're selling newspaper copies, maybe it's on the unit sales, or maybe it's on the number of stands that you're on, or if you're online, maybe it's the number of subscribers, or maybe it's the number of eyeballs, or maybe it's the number of advertisers. It could be many different things. The important aspect is that at your stage of development, traction could end up meaning different things, but it's going to be necessary that it's definable. It's also going to be necessary that it's going to be attributable, because I want to be able to come in, and when I'm assessing your business, being able to look through, and certainly you as a manager will want to be able to go through and be able to say, because I did XYZ, this led to the result that I've defined as traction. And now I can understand that by doing this action, it is attributable to that traction. And I can say that because I also have traction that is measurable. And so this is something that I find very important, and it really relates back to what I said earlier in when I was talking about the planning, which was setting up your milestones and KPIs. Because if I can see that, and I can see that you're getting traction, then I'm going to have more confidence that what you're doing and what I'm seeing, especially more so for earliest stage companies, what you're doing is repeatable and scalable. Now, it may not be scalable in the unicorn terms that you're going to all of a sudden become this massive company. But what I'm trying to assess is that, can you become more efficient, and is your margin going to show improvement with greater size and scale? And that's really going to be around the core assessment on the product. There's several other aspects, but I think this is a primary focal point here. Now, if you can get me sold on the people, if you can get me sold on your process, and if you can get me sold on the product, you really have me hooked almost at this point. And then it's going to move into what's the actual potential here. And the potential is, I'm going to be trying to understand and assess what the market size and profit potential is. Now, again, different investor types will have different profit and return on investment criteria. But this is where it comes in to trying to assess whether or not this is an investment that's going to end up getting me where I need to be. So going through and doing the assessment on what total addressable market is, serviceable market, all those acronyms, the TAM, the SAM, et cetera. And so, yeah, is it going to give me enough bang for my buck in order to make it worthwhile, in order to jump in and do this investment? And then lastly, as with any investor, almost any investor that's coming in there, eventually an investor is going to have to get out, or want to get out, I should say, rather. So how is that going to be made possible? Again, if it's a long-term investor, it may not necessarily be very visible, but there needs to be some sort of an ability to hypothesize around what that could be. And there's companies that I've seen in the past where I really like the company, but because I don't see any way of being able to get my money out of an investment, I'm not able to take that leap and go the equity route, and I'll have to look at some other forms of investment. So I think to recap, I mean, there's many different areas that I could continue on with and start talking about as you get further down the road, and what terms could be and valuations. But I'm going to leave that out of the scope because we're getting close on time as it is. But I'd just like to recap that it's very important that that you really do the prep work before you get out there and get on the fundraising circuit, so that you understand really how much you actually need, what you're going to use it for. And you can kind of begin running in parallel some of the initial stages of screening the investors, so that you can understand who you would be raising it from. Understand, again, who is a fit, who do you fit, and who fits you. And make those connections, make those relationships, and then have a strong understanding of the characteristic that investor is going to analyze, so that you're prepared and ready for those conversations when they happen. And at that, I'd like to thank you guys for having me on, and hopefully I've left enough time for questions. So I'm gonna exit the share screen, and hopefully we can jump into some Q&A.
Thank you, Kevin. That was awesome. We're a little bit over time. I hope some of you can stick around, and no, that's fine, really, because I mean, I was pretty focused there. Please stick around, ask your questions. We'd like to ask the questions you've put into the chat box. Very quickly, before Alan jumps to the questions, I just want to remind you, it sounds like a plug, but it isn't. We have a new podcast out, and it's called Splice Ping. What else would we call it? Kevin features on the first episode of Splice Ping, and he's talking with a bunch of other funders and grantors about everything you wanted to ask a funder and a grantor, but couldn't bring yourself to. We'll put the link in the chat box very soon. Oh, already done. Shirley's way ahead of me. Catch Kevin on that as well. Alan, let's do some questions.
Let's try to cram in maybe 2 questions before we wrap up the evening here. Annalise has a question. What are the key differences between funding for companies that are, basically for-profit versus non-profits? How would you think about funding in that space?
For us, we'd only go towards the for-profit. Not-for-profits are a little bit out of our spectrum. There's some that have participated in programs that we have running, but there's no equity in a not-for-profit, so that automatically precludes the ability to do equity investments. It doesn't necessarily mean that a not-for-profit can't transition. We've seen that in certain circumstances. But primarily it's the commercially mindseted for-profit organizations for the most part.
Can you elaborate as to why that's the case? Like, what is the overall framing that you apply to it that excludes nonprofits?
So not-for-profits don't actually have equity. Perhaps there's some jurisdictions that could be a bit different, but because they don't have beneficial ownership of the entity and they're set up as that form, hence the name not-for-profit. There's not profit that can go to the equity holders. It doesn't provide the sorts of returns that an equity investor would require. And if there's an equity investor that's somehow pulling out massive money from a not-for-profit, they should lose their not-for-profit status.
Which is a story in itself.
Yeah, there are other potentials of being able to do loans to not-for-profits. There's some caution with loans simply because you have to understand the obligation aspect of that. But if you're in a non-for-profit that can sustain, perhaps it's an option for you.
I'm going to ask one quick question from Khalil. When looking at partners, is it wrong? I love this question. Is it wrong to look at them not as permanent, but rather as a stepping stone to total independence?
I wouldn't necessarily say it's wrong, because there's a temporal aspect when you're talking about investors, because they're going to come in and they're going to at some point need to get their money out of it. I don't necessarily think they would want to view themselves as your bridge to something bigger and better. Some of them may view that. If you're focusing on the early stage companies, to say, hey, I was seed capital in Grab or Gojek would go a long way. It'd be great to say, hey, I was their stepping stone. But the aspect of ultimate independence, I think most companies that go in for equity fundraising have a tendency of continuing that cycle for a few rounds. So that pathway to getting ownership of your business back may not actually fully take hold. There's a lot of research studies that you can find in regards to the pathway of what your ownership levels will be. And chances are you may end up retaining some level of control, but your percent ownership will likely be in a minority 10 years down the road.
Yeah. Can I just sneak in one last question before we wrap up the evening? And this is, something that I've always been curious about. So, Kevin, you see a lot of investment, ideas being thrown at you. What is the one thing that all entrepreneurs make as a mistake when trying to fundraise? Media entrepreneurs specifically.
Yeah, that's a good question. It's hard to narrow it down to a single one, but I think on the relationship aspect, I've had a number of companies reach out and start off with the ask without trying to build any sort of relationship basis. And if you're just sending me a slide deck without any sort of warm up, honestly, these days I get so many phishing emails that if I see just a link, I'm probably never going to click on it. And so it's best to try and get some level of introduction. So if I see an email with a link, I already know who you are. There's definitely a lot of companies out there that have sent me pitch decks on companies that completely fall outside of our criteria and I could never do anything with. Maybe they're sending mass emails or whatever the case may be. Don't do a mass email where I can recognize that I'm on BCC, because it certainly doesn't make me feel special. And it's probably not a great way in order to get a response. And last one that I would mention is the being overly unrealistic with your expectations. Not every company is going to grow 100x per year. Growing 2x or even 1.5x could be perfectly fine for the particular circumstances. So don't try and toss up massive numbers just for the sake of massive numbers.
Fantastic. Kevin, thank you so much. Thank you, everybody. I just want to quickly thank all of you for coming. I want to thank quickly people who paid for tickets for other people to attend. There were folks on here that bought extra tickets so that other people could attend beta. We really, really appreciate you. You know who you are. And if you don't, we're going to shout you out the next beta. Do come back tomorrow and next week. This is going on for a month. We're looking forward to having you back here. Facebook Journalism Project, Konrad Adenauer Stiftung, Google, Luminate, MDIF. Thank you guys at MDIF for doing this one. AFP, FOIO, and IMS, and our friends at Click to View and Puma Podcast. Thank you so much for this. We'll see you guys tomorrow. Good night, everybody.